Trading Terminology, Part 8. Trendline. A trend line is a straight line drawn on a chart that connects two or more price points and extends into the future to act as a line of support or resistance. Uptrend line, drawn by connecting higher lows, indicating bullish momentum. Downtrend line, drawn by connecting lower highs, indicating bearish momentum. How to draw a trend line. Choose a time frame, 15 minutes, 1 hour, daily, etc. In an uptrend, connect at least 2 higher lows. In a downtrend, connect at least 2 lower highs. Extend the line forward. The more times price touches the trend line without breaking it, the more reliable it becomes. Tips. Don't force the trend line. It should naturally align with the actual price movement. Avoid connecting points just to make it fit. Clarity matters. A clean, well-defined trend line is more reliable and actionable than one drawn through noisy or inconsistent price action. Watch the angle. Extremely steep or flat trend lines may be less sustainable or harder to trade effectively. The more times a trend line is tested without being broken, the stronger it becomes. Indicators in technical analysis. Indicators are mathematical calculations based on price, volume, or open interest. They help traders interpret market behavior, confirm signals, and predict potential price movements. Indicators are typically overlaid on price charts or displayed in separate panels below the chart and are used to guide trading decisions. Types of indicators. Trend indicators help identify the overall direction of the market. Examples: moving averages, parabolic SR. Momentum indicators show the strength or speed of a price movement. Examples: relative strength index, stochastic oscillator, commodity channel index. Volatility indicators measure how much the price fluctuates over a period. Examples: Bollinger Bands, average true range. Volume indicators analyze trading volume to confirm trends or spot potential reversals. Examples: volume on balance volume. Volume weighted average price. Pullback. A pullback is a temporary price reversal within an existing trend. It's a brief move against the main trend, like a pause or dip, before the price resumes its original direction. In an uptrend, a pullback is a short-term decline. In a downtrend, a pullback is a short-term rally. Pullbacks are not trend reversals. Instead, they are healthy corrections that often provide opportunities to enter trades at more favorable prices. Why pullbacks matter? They offer potential low-risk entries in the direction of the prevailing trend. They help improve the risk-reward ratio by allowing traders to enter on retracements rather than at extended price levels. Pullbacks often occur near key support/resistance, trend lines, or moving averages, making them strategic zones for trade setups. Bid and ask prices. The ask price is the lowest price at which a seller is willing to sell a security. It's the price at which market makers or sellers are ready to sell. The bid price is the highest price a buyer is willing to pay for a security at any given moment. It's the price at which market makers or buyers are ready to buy. Key point. The difference between the bid and ask is known as the spread, which reflects market liquidity and transaction costs. Ask-bid spread. The ask-bid spread, also known as the bid-ask spread, is the difference between the ask price and the bid price. It's a key indicator of market liquidity and the cost of executing trades. Formula: ask price minus bid price equals spread. What the spread tells you. Narrow spread indicates high liquidity, easier to enter or exit trades with lower transaction costs. Wide spread indicates low liquidity. Trades may be more expensive, with a higher chance of slippage. Slippage. Slippage refers to the difference between the expected price of a trade and the actual price at which it is executed. It typically occurs when a trade is filled at a worse price than expected, and is most common during high volatility, low liquidity, when using market orders. Why slippage happens? Slippage occurs due to rapid price changes or insufficient market depth. When you place a market order, you're essentially saying, execute my trade now at the best available price. But if the market moves within milliseconds before your order is filled, you may be filled at a different and often worse price. Key points. More likely in fast-moving or liquid markets. Can affect both entry and exit of trades. Using limit orders can help reduce or avoid slippage.